Right now, a massive portion of the US stock market, and potentially your retirement account, relies on a single fragile assumption: the idea that American tech companies will make trillions of dollars because the rest of the world will be forced to use their artificial intelligence. But the US government just broke that assumption. Recently, the Commerce Department ordered major AI developers to cut off foreign access to their most advanced models, locking out users across the globe. The backlash was immediate. Instead of begging for access, allied nations realized they had options. France fired its primary American AI contractor. Germany walked away. Spain and Britain told their domestic companies to stop signing deals entirely. The big tech firms pushing these tools are doing so because their primary businesses have stalled. They don't have a new search engine or a revolutionary new smartphone to sell, so they are pouring over $1 trillion into large language models to maintain their growth narratives for Wall Street. This massive spending masks three structural failures in the AI industry. Once investors look past the hype and realize the math doesn't work, the capital holding this entire market up will vanish. The first problem is how corporate America is actually experiencing this technology. A CEO might approve a $50 million AI budget, only to realize months later that the company cannot measure a single tangible return on that investment. Vendors price by the token, essentially a word. You pay for every word, even if the AI fabricates an answer. Beyond unpredictable costs, there's a severe data security issue. Daily workflows through these models expose the unique trade secrets that make the business profitable. Those AI vendors can then use that specialized corporate data to train their future systems. Businesses are effectively paying millions of dollars to hand over their intellectual property, helping vendors build models that will eventually become their direct competitors. Until enterprise clients can download, own, and operate localized models on their own private servers, they will refuse to adopt mass-market AI at the scale Wall Street requires. The second problem is unit economics. This chart compares traditional software to AI. Software is highly profitable. Once you build the code, selling extra copies costs nothing. The revenue line goes up, but the cost line stays flat. AI breaks this rule. Every single query costs money, meaning the cost line rises linearly alongside revenue. AI operates like a restaurant. Serving more customers means buying more ingredients. Every prompt consumes raw materials and wears down expensive computer chips. Because of this heavy physical cost, the leading developers are burning cash at a staggering rate. OpenAI alone burned through roughly $20 billion in a single year just to keep its services running. To maintain that massive output, tech companies are constructing data centers that require multiple gigawatts of electricity. We are reaching a point where powering these models demands the equivalent infrastructure of several nuclear power plants. To keep this hardware market moving, the industry has turned to a highly unusual financing structure. Major chip makers are now lending billions of dollars to smaller cloud computing companies, specifically so those smaller companies can afford to buy the manufacturer's chips. When a vendor has to finance its own buyers just to maintain sales volume, it points to an industry devoid of real organic demand. Once those debt markets dry up, the circular capital loop will collapse. The third structural failure comes from overseas. The United States is currently spending nearly 10 times the capital on AI infrastructure as its primary geopolitical rival, China. Instead of burning billions to teach models from scratch, Chinese developers use a shortcut called distillation. They feed complex problems to the most expensive American models, copy the correct answers, and use that data to train smaller, efficient local systems. The result is an open-source model performing at 90%. When this market corrects, it won't be telegraphed by empty construction sites. During the dot-com crash in 2000, telecommunications companies kept laying billions of dollars in fiber optic cables well into the following year, long after the stock market had plummeted. The trigger this time will likely be a single, boring earnings call. The exact moment Wall Street rewards a tech giant for cutting its AI capital expenditures, it will give every other CEO permission to pull back their spending. We can already see the warning signs in the market. The companies selling AI chips and equipment are trading at historic highs, while the hyperscalers, the companies actually buying all this equipment, are seeing flatline returns. Wall Street is rewarding the sellers and ignoring the companies spending the money.
The ultimate silent alarm is the credit spread in the bond market. This spread is the gap between a safe government bond and a risky corporate bond. When lenders begin to suspect these tech companies cannot pay back their massive infrastructure loans, they will demand higher interest rates, and that spread will violently widen. The defining feature of this technology cycle will not be who builds the smartest model. Instead, the victor will simply be the company that manages to be the survivor of its financial collapse.